everyone, and especially to our lecturer Mr. Amir Faris bin Al-Azhar. My name is Norazani Hazika, and today I will be presenting the background for our report on Mr. DIY and 99 Speed Mark. To begin with question 1, let's look at Mr. DIY Group Berhad. This company started back in July 2005 as a small hardware store in Kuala Lumpur. Over the years, it has grown into Malaysia's largest home improvement retailer by sticking to its always low prices philosophy. A major turning point was its listing on Bursa Malaysia in 2020. It solidified its place in the market. To reach different customers, they launched sub-brands like Mr. Dollar, Mr. Toy, and Mr. DIY Plus. Recently, they have been focusing on using robotics to automate their warehouses and installing solar panels to help manage long-term operating costs. On the other hand, 99 Speedmark Retail Holding Berhad has an equally successful story. It was founded by Lee Tiam Wah in 1987, starting as a single mini market in Klang. Their core strategy is near and dear, focuses on placing stores right inside residential neighborhoods, so daily essentials are easy to reach at low prices because they run on a high volume but low margin model. They rely on efficient distribution center and simple store setup to save costs. Following their recent IPO, they are now moving aggressively into East Malaysia and upgrading their digital payment system to stay modern.
Hi, my name is Nurizati. Today I will present a financial analysis comparing Mr. DIY Group and the 99 Speed Mark for the year 2024. My presentation is divided into two parts. Section 1.2, the rational analysis, and the section 1.3, the performance evaluation. So first, let's look at the calculated ratio for both companies. For liquidity, Mr. DIY has a current ratio of 1.36 and quick ratio of 0.35. In comparison, 99 Speed Mark show a current ratio of 1.45 and a high quick ratio of 0.82. For asset management, Mr. DIY record an inventory turnover of 2.05 times and a total asset turnover of 1.18. Meanwhile, 99 Speed Mark demonstrate much higher activity when inventory turnover of 12 or 40 times and a total asset turnover of 3.25. For debt, DIY has a debt ratio of 58% and a time interest earned of 12.45. 99 Speed Mark's debt ratio is 62% with a time interest earned of 8.30. For profitability, Mr. DIY achieved a net profit margin of 12.3%, an ROA of 40.5% and RE of 34.5%. 99 Speed Mark records a 4.9% margin but a higher ROA of 15.9% and ROE of 31.0%.
Now, let's look at section 1.3 evaluation of performance. Now, I will evaluate the performance of each company based on their specific operational strategies and financial events in 2024. First, let's look at the Mr. DIY Group. The first one is cash flow capability. Their liquidity is heavily tied to their vast inventory levels. With a quick ratio of 0.35, the company relies on its ability to sell off stock to meet its 1.23 billion ringgit in current liability. Next is asset management efficiency. We see a slight slowdown in inventory turnover to 2.05 times. This is due to their aggressive expansion of 174 new store, which require a significant increase in inventory to 1.08 billion ringgit to support the new location. The third one is debt management. Their debt ratio rose to the 58%. This was a strategic move to finance their nationwide network expansion and ongoing investment in warehouse automation. And the last one is profitability trends. Despite the cost of expansion, Mr. DIY remains highly profitable with a net profit margin of 12.3%, driven by strong brand power and effective cost control. Next, moving to 99 Speed Mark. The first one is cash flow capability. They show a massive improvement in liquidity with their current ratio rising to 1.45. This was primarily driven by the 698.1 million ringgit in cash proceeds received in 2024. The second one is asset management efficiency. Their efficiency is exceptional, clearing inventory 12.4 times a year. This reflects their high volume models where fast-moving where fast-moving consumer goods are rotated roughly every 30 days. The third one is debt management. The company significantly reduced its financial risk. The debt ratio dropped from 0.80 to 0.62 as they use IPO funds to strengthen their equity base and reduce reliance on borrowing. And the last one is profitability trends. Their profitability is on an upward trend with a 4.9% margin. More importantly, they receive a superior return on assets of 15.9%, proving they can generate high returns through operational scale and efficient distribution. In conclusion, both companies are performing well. Mr. DIY focus on growth through strong expansion and high margin, while 99 Speedmart has used its IPO success to strengthen its position and maintain its high volume efficiency.
Moving on to our next question, which is financial recommendation based on the 2024 analysis. First, Mr. DIY should improve its liquidity. There is a big gap between their current ratio of 1.36 and their low quick ratio of 0.35, meaning too much cash in stock in unsold stock. They need faster inventory clearance to free up that cash. Second, 99 Speedmart need to protect its net profit margin of 4.9% by using more cost-saving technology in their logistics. They can ensure their high sales volume lead to better net income. Third, both companies have debt ratio between 58% and 62%. They should use their strong cash flows to pay down high interest debt to gain more financial flexibility for their future. Finally, both retailers should speed up services like click and collect. This increases revenue from existing stores and improves their return on asset, which is ROA, without the high cost of opening new building. So, in conclusion for this section, making this specific financial adjustment will help both companies stay resilient and much more profitable in the long run. Thank you.
Hi, good day everyone. My name is Zalia Zulaika. Today I will present a comparison between two retail giants in Malaysia, which is Mr. DIY and 99 Speedmart. We will look at their financial performance in 2024. Their unique strengths and the opportunities they have for future growth. Both are successful, but as we will see, they have very different business styles. Let's start with the numbers. If we look at leverage or debt, 99 Speedmart is very lean with a debt to equity ratio of only 13.7%. In contrast, Mr. DIY is much more aggressive at 18.4%. This shows Mr. DIY relies heavily on financing to fuel their rapid expansion. However, the biggest difference is in inventory turnover. 99 Speedmart is incredibly fast. They clear their stock every 21.8 days or 22 days. Why? Because they sell daily essentials like rice and oil. Mr. DIY takes 155 days to turn over inventory because people don't buy hammers or hardware every day. In terms of liquidity, Mr. DIY has a stronger safety net with a current ratio of 2.4 times compared to 99 Speedmart's 1.8 times. This means Mr. DIY hold more liquid assets to cover their short-term commitments. Now, let's talk about Mr. DIY Group. Their first strength is their direct sourcing strategy. They buy 70% of product directly from manufacturers, mostly in China. By cutting out the middleman, they maintain a high profit margin of about 45%. Their second strength is data-driven clustering. They open multiple stores in one area to dominate the local market. With over 1,200 stores, they know exactly where to go. Looking ahead, Mr. DIY has two big opportunities. First is brand diversification. They are growing sub-brands like Mr. Dollar and Mr. Toy to reach different customers. Second is lean management. By using AI and automation in their warehouse, they can speed up their 155 days inventory cycle and free up millions in cash. Next, we look at 99 Speedmart Retail Holdings. Their main flex is near home proximity. With over 2,600 outlets, they are everywhere. Most customers live within walking distance, which creates high recurring foot traffic. Their second strength is inventory velocity. Because they focus on fast-moving consumer goods with FMCG, their cash isn't tied up in slow items, keeping their cash flow very healthy. For opportunities, 99 Speedmart is looking at Ace Malaysia. After their 2024 IPO, they have a massive cash reserve to expand in Sabah and Sarawak. Lastly, there is a gap in their digital ecosystem. Currently, they are quite traditional. By launching a loyalty app or digitizing customer data, they can offer personalized deals and compete better in the e-grocery space. To wrap up, 99 Speedmart dominates in operational speed and density, while Mr. DIY leads in profit margin and market clustering. Both are powerhouses shaping the Malaysian retail landscape. That's all from me. Thank you.